All right, enough of the doom and gloom already, because our next guest, who happens to be a very successful market veteran, is boldly predicting that the Dow will go to 20,000. That is right, 20,000. And he says it could happen in the next 12 to 18 months. Here now is James Altucher, Managing Director at Formula Capital and author of the brand new book, How to Be the Luckiest Person Alive. He's the brains behind the recent article, Next Stop, Dow 20,000, which is exactly why he's on the show. We read it, and we called him, and he decided to come on the program. James, 20,000 on the Dow. Make your case. It's on a David Letterman style top 10 list.
Exactly. Well, Brian, I want to take just a little break from all the doom and gloom pessimism. People act like every economic report should either crash the market or boom the market. But let's just take a look at some things that are reality. QE2 has not even begun to have an effect yet on the economy. I mean, just because the printing press is printing doesn't necessarily mean it's affecting the economy 1 second later. It typically takes 6 to 18 months for the economy to have any effect from the stimulus. Next, we're still, Obama's basically done nothing to the economy. He's basically extended Bush's tax cuts. We'll see what happens with health care. He's kind of backed off on Wall Street. The actual stimulus isn't just $600 billion, but when you use those stimulus dollars to buy a donut, and then the donut guy buys a newspaper, and the newspaper guy buys some furniture, there's a multiplier effect. $600 billion could be up to $3 trillion worth of stimulus on the economy. That's a significant. We're actually in danger of a bubble.
Except a few $100 billion of that went to transfer payments, not to direct investment.
Okay, a few $100 billion of $3 trillion. I'll deal with that. Again, $3 trillion is an enormous effect on GDP. Finally, companies are sitting on $2 trillion in cash, the greatest amount of cash in history. This is the only recession where companies quarter over quarter increased their cash every single quarter of this recession. They never went down a quarter. So again, what are they doing with this cash? Finally, they're spending it. Stock buybacks are at the highest levels in history. They're actually announcing that they're going to take, the stock market supply and demand. If you remove the supply of shares from the market, what happens? In any market in the world, price goes up. That's what's going to happen here. We have some more, but let's...
No, you keep going quickly. Let's boogie through this here. You think temp workers? Okay, we know that. We got enough on the jobs. Go back to the market stuff.
Okay, temp workers, though, are being hired. That means full-time workers are coming next. Corporate profits are obviously at their highest point ever. People say it's going to come down. How do you know future profits? But the reality is right now, they're at the highest ever. Major stocks like Microsoft, Apple, Intel are all trading around 10 to 13 times forward earnings. And let's not forget innovation. We all have iPads now. A year ago, none of us had iPads. Every year, there's new biotech drugs, iPads, everything. Google has cars that are driving around on highways without drivers now. So this is an innovation economy, and it's going to stay that way. And that's what I'm going to bet on. You have to bet on the innovation economy we've always had.
I agree with all 10 except for numbers 1, 3, 4, 9, and 10.
Then let's do CNBC Fight Club right now. You're taller than me. I'll take you on.
Yeah, Scott Minerd is bigger than all of us. He's here with us as well. Phil Orlando's with us here. All right, guys. Phil, I want to start with you because James makes some very good point. I don't agree with all of them, but Phil Orlando, could the Dow hit 20 grand in a year and a half?
I directionally agree with James. I think he's made some excellent arguments there. I would focus on two of his points. Number one, monetary policy does work with a lag. It takes about 6 to 9 months for 1/2 of the effect of monetary policy to begin to work, about 12 to 18 months for the full effect to be felt. So if the Fed started injecting liquidity through QE2, I guess last summer, really it will be the third and fourth quarters of this year where we'll start to see that stimulus.
And the full boom in 2012. I'm actually worried for bubble proportions towards the end of 2012 because I don't think we need QE2.
Let's get it. Scott, I want to bring you in because, listen, I know equities not necessarily your primary focus. That is bonds. But if they're right, what would that mean for the bond market? Or if you don't think they're right, tell them why.
Well, let me support James' argument for 1 minute. If you look at the Fed model, which just basically takes where 10-year treasuries are trading, and it correlates to price-earnings ratios, the price-earnings ratio on the market today should be about 22 times. So we have lots of room for multiple expansion at current earnings. So I could see supporting James's argument that we could have a massive rally in treasuries or in stocks. I'm sorry, in stocks. As for the fixed income markets, Brian, the history of the Fed is that after the end of recessions, they have not raise short-term rates until about 3 years after the end of the downturn. So we are still a good 12 to 14 months away from seeing any serious moves on the part of the Fed. And given that overnight rates are locked in here around 0%, the normal relationship between the 10-year note and Fed funds ranges between 2.5 percentage points and 4 percentage points.
Well, let's not forget also, the market tends to go up when interest rates start to rise. It happened in 1999, it happened in the mid-90s. So rising interest rates aren't necessarily a bad thing for the stock market. It means the economy is growing and the Fed is starting to get worried about, potential bubbles.
Right, but my point here, James, is not that you're not correct. You're 100% correct. It's just that we are a long way off from seeing a material rise in interest rates, which is just going to continue to support corporate earnings and support the multiple in the stock market. And I think stocks will go higher just because the multiple is going to expand.
Phil, we talked a lot this week about whether or not there's too much, sort of hyperbolic behavior in this market about, doom and gloom. To James's point, right, it's either, we're doomed or we're going to boom, right? There's no middle ground. Is the worst behind us? I mean, is it only going to get better day by day for the next few years? Please say yes.
The longer-term answer to that is yes. The near-term answer is that undeniably we are in an economic soft patch, but we think that the catalysts for that soft patch are very much transitory. The earthquake in Japan, the weather issues, the spike in commodity prices. We think that those issues are going to fade over the course of the third quarter and that we're going to enjoy a very strong rally through the end of this year and into calendar 2012 for many of the reasons that James identified.
Phil, Scott, and James, I love the discussion because it was nothing but positive. Very good stuff, guys. We do appreciate your time tonight. Thank you. Have a great weekend.
Thank you. Have a great weekend.
Take care, Brian.